BlackRock, the world's largest asset manager, has shared a cautious outlook on the likelihood of significant interest rate cuts by the Federal Reserve. While market speculation hints at drastic cuts due to inflation cooling, BlackRock strategists, including Wei, caution that these expectations may be overly optimistic. Let's dive deeper into their reasoning. Current market situation and rate projections. The Federal Reserve has raised interest rates aggressively over the past 2 years in response to high inflation, pushing them to their highest levels since the early 2000s. Many analysts predict that the Fed will begin cutting rates by mid-2024, with some forecasting cuts as large as 240 basis points by the end of the year. However, BlackRock's analysts believe the cuts will be more gradual, possibly between 75 to 100 basis points, due to persistent economic factors such as wage growth and the tight labor market. Why BlackRock sees limited rate cuts? BlackRock's outlook is built on the idea that inflation pressures will remain strong, particularly in key sectors like housing and services. These areas are less responsive to the Federal Reserve's rate hikes. Additionally, the U.S. economy continues to show resilience, with strong consumer spending and low unemployment levels, reducing the Fed's need to make drastic cuts. Global events, such as energy price fluctuations and geopolitical tensions, also play a role in BlackRock's cautious approach. Comparison with other analysts and institutions. Not all institutions share BlackRock's cautious view. For example, Goldman Sachs holds a more optimistic outlook, believing inflation is coming under control and that larger rate cuts are likely. This divergence in opinion shows how different financial institutions approach the current economic landscape. While BlackRock emphasizes long-term inflation trends and market volatility, others see immediate relief on the horizon. Impact on investors and markets. For investors, BlackRock suggests adjusting their strategies. They anticipate that the yield curve may steepen, with short-term treasury yields rising as market expectations shift. This could influence bond portfolios and stock market performance, especially in the tech and growth sectors. As borrowing costs remain high due to elevated interest rates, corporate earnings and investments may also face constraints. BlackRock recommends maintaining a diversified portfolio to manage potential market volatility in the months ahead. Conclusion and key takeaways. To summarize, BlackRock's skepticism around significant Federal Reserve rate cuts is grounded in the belief that inflationary pressures will persist longer than many expect. This suggests that investors should prepare for a more volatile market environment and a slower pace of interest rate reductions. In this climate, thoughtful financial planning will be essential for navigating the uncertainties ahead.